In 2023, global sustainable investments skyrocketed to over $35 trillion. Meanwhile, the S&P 500 danced on a high wire of extreme volatility. What forces are really driving these seismic market shifts, and how should you react? In this video, you'll discover the complexity behind these numbers and the steps you need to take to optimize your investment strategy amid uncertainty. The stock market this year is a mosaic of rapid highs and dramatic falls. Recent geopolitical tensions, such as conflicts involving major economic players, have injected a significant degree of unpredictability. In recent times, the S&P 500 has increasingly mirrored this volatility due to such global events and internal economic uncertainties within the United States. Historically, geopolitical tensions have led to market instability. According to data, the S&P 500 index has registered multiple instances of over 1% fluctuations within single trading sessions more than 50 times by mid-year 2023. This indicates not just a natural market ebb and flow, but heightened investor sensitivity. Apple and Microsoft have continued to shine in this clouded sky, propelling the Nasdaq Composite Index to record groundbreaking milestones. By capitalizing on technology's consistent advances, these giants helped the Nasdaq rise by over 15% in just the first half of the year. Over the past decade, tech sector growth has been critical in periods of overall market downturn. Yet it remains vital for investors to resist overconcentration in tech stocks, as high valuations pose inherent risks. Sustainable investments have touched a new pinnacle, surpassing $35 trillion globally in assets. This trend is a testament to both ethical considerations and perceived long-term resilience. BlackRock notes that sustainable investing helps mitigate potential future risks. This shift mirrors historical movements such as the post-Great Recession surge in socially responsible investments, which leapt 34% from 2009 to 2012. Investors are not only recognizing the moral imperatives but also witnessing tangible returns from these investments. The Federal Reserve's policies have further influenced market movements. Interest rate maneuvers remain under the microscope. As inflationary pressures ebb and flow, the Federal Reserve has taken a more hawkish stance, potentially adjusting rates across several quarters. The correlation between federal rate increases and S&P 500 performance shows that when rates rose sharply during the early 1980s, the market initially stumbled, but later adjusted with robust gains. The S&P 500's volatility is also shaped by global economic shifts, with key economies like China and the European Union experiencing various degrees of stagnation or expansion. Investors are keenly watching for cues. In times of economic hardship in the 1998 Asian financial crisis, market fluctuations were just as rampant, offering a lesson on the importance of diversified global portfolios. ESG, or environmental, social, and governance factors, have risen to the forefront in 2023. A significant 30% of investors worldwide now integrate ESG criteria into their decision-making processes. Companies boasting higher ESG scores have shown resilience during turbulent market phases. As Warren Buffett suggests, investing requires foresight into these future trajectories of growth, and ESG policies could redefine these trajectories in unforeseen ways. Considering this complex landscape, how should you tailor your portfolio? Going forward, diversification should be paramount. By blending equities, bonds, and alternative assets, you create a buffer against isolated downturns. For example, ETFs that employ ESG filters provide a balanced exposure while aligning with the sustainable investment theme. Historically, such funds have outperformed conventional strategies over a similar timeframe, offering an average 10-year return rate of approximately 12% compared to the standard stock indice's 9%. Regular portfolio reassessment cannot be understated. In 2023's volatile climate, frequent evaluations, as often as quarterly, allow you to rebalance towards more stable or growth-centric paths, depending on evolving market conditions. Fast technological advancements and evolving sustainable assets should be carefully assessed within your allocations. In conclusion, the 2023 stock market is not just about numbers but understanding the underlying shifts in global investing behavior. This period marks a transformative era, from technological enthrallment to sustainable imperatives. By staying informed and adaptive, you can hedge against major threats and grasp potential opportunities. YieldWire is your precise guide in navigating these financial waters. Subscribe for more data-driven breakdowns and industry insights. Check the description for detailed analysis and further reading resources. This video is for educational purposes only and is not financial advice. Always consult a licensed financial advisor before investing.